Hi, I'm Jimmy. In this video, we're going through the consumer defensive sector to try to identify companies, ideally dividend paying companies, that could be good investments for the next few years. So, I have a fairly tech heavy portfolio. In fact, my portfolio is very mega cap heavy. So, I'm looking for more companies in more different sectors. So, the plan is to go through each of these sectors and identify a handful of companies that could be good investments for the next few years. Now, if you have any companies that you think would be worth researching, please let me know in the comments below. But for now, I get a handful of consumer defensive companies that could be interesting to do deeper dives on. Let me know which one you think we should do next. Okay, so our first company is Cal-Maine Foods, ticker symbol CALM. Now, Cal-Maine Foods is the largest producer and distributor of eggs in the United States. And recently, they've made some acquisitions to expand their, let's say, their breakfast offerings into other breakfast foods. For example, they bought into a company that does like waffles, pancakes, things like that. But they are predominantly known for being the largest distributor of eggs to like supermarkets and club stores, things like that. And when we're over on the Investors Grow website, well, there's a few things to notice first. Down here, we got these star systems. These star systems are specifically designed to look at the past few years and try to identify the trends. How's revenue growing? How's profit growing? How's margins doing? Things like that. And we can see that we have three stars, which is very, very good. Now, when we jump over and look at their fair value, well, the stock looks fairly undervalued. In fact, when we look at the PE ratio here, well, historically, when we compare this to their historical averages, yes, they have an extremely low PE ratio right now. But they actually have historically, they always seem to have a fairly low PE ratio. So this is on the lower end. And if we use their averages, this stock is undervalued, but we shouldn't overreact to how low this PE ratio is. Then when we jump over and look at their dividends here, well, this is one of the things that drew me to this stock. One, this is a very high dividend. Now, I do not expect that dividend to maintain this level, just because eggs and stuff have prices were really ramped up over the past few years. And that's likely to contract some over the next year or two. But over the long run, this could be a fairly defensive name that could be a really interesting one to do a deep dive on. Again, let me know in the comments below, which one of these companies do you think we should do a deep dive on? And if you know of any other companies in the consumer defensive sector, please let me know. Okay, the next company that looks interesting is Fragrance Company, IPAR. I'm not sure how to pronounce that, but it's a fragrance company. In fact, they're the manufacturer of a lot of the fragrances behind many of the big brands out there. Think of Coach or Kate Spade or Jimmy Choo or DKNY, Guess, Lacoste, brands like that. They are the manufacturer behind those brands. And when we jump in and look at their summary page, well, we can see again, we get 3 stars for all 3 financial statements, which at least tells us, as of now, as of the past few years, this company has done fairly well from a business perspective. And then when we jump over and look at the fair value section, well, here we got a ton of different valuation methods, all pointing to undervalued for this stock. Now you can see here with these 2 stars, well, based on this company's financial profile and the sector that they're in, it looks like the 2 recommended valuation methods are both PE ratio and discounted free cash flow. And both of them, as of right now, look undervalued. Then when we jump in and look at their dividend, well, their dividend has done fairly good. Now we can see back in 2020, we can all guess what happened in 2020. Well, back then it looks like they reset their dividend and they've once again started increasing their dividend. So this could be a fairly interesting one to consider researching as well. Okay, next up, we've got a company called Armanino Brands of Distinction. Now, this one's a real interesting one because it's super small. This has about a $350 million market cap. And essentially what they do is they sell frozen Italian foods. Picture like the little pastas you might buy at a supermarket or something like that. That's what they do. Now, this came across my desk from a potential acquisition standpoint. So I was doing research on some bigger companies and bigger than $350 million market cap. And this company from one of the analysts had said, hey, this would be a good acquisition for that company. So that kind of, I started diving into it. And much to my surprise, when I jumped in and looked at it, even though it's a super small company, well, again, we got 3 stars right across the board. Then when we jump in and look at the fair value, well, this one's not quite as undervalued as the other ones in that it's not undervalued. Specifically, when you consider when we jump over to the profile section here, well, we can see that this stock is way up over the past year. Now, I'm not sure that necessarily should deter us from doing the research on the company if we think this is an interesting one. But I do think that if there was an acquisition of a company like this, well, this will likely get sold at a fairly decent premium. So there could be still some potential upside with this one. And in the meantime, they do pay somewhat of a dividend. You can see they got a semi-consistent dividend history. So if we are interested in this type of company from a defensive perspective, especially if we're looking for a small cap one, well, at least we could collect a dividend while we wait and hope for an acquisition or something like that. Okay, now we jump over to our next company in e.l.f. Beauty, ticker symbol ELF. So e.l.f. Beauty is a cosmetics company. Essentially, they manufacture makeup. And they claim that what they're trying to do is they're trying to manufacture high quality makeup at reasonable prices. Now, here, we don't have three stars. We got 2 3-stars. Cash flow statements trailing a bit behind with the 2, which isn't too bad. But revenue has been ramping up a decent amount, which is why the income statement is showing a 3-star compared to the cash flow statement. Many times, cash flow will trail what revenue is doing. Could take a few years as they continue to expand. In fact, if we jump in and look at a chart of revenue, well, we can see that with e.l.f. Beauty, revenue is ramped up somewhat quickly. And this could be an interesting company. Now, because of this, well, a lot of times these companies you have to pay a premium for this for the faster growing companies. So jumping over to the fair value section here, again, this one's, although some of it looks like it could be undervalued relative to their own history, it is slightly on the more expensive end. From what dollar amount are we paying per dollar of earnings? So something to consider. Now, this company does not pay a dividend, so it doesn't give that to us. But as I was going through a bunch of these companies, this seemed like an interesting one to consider. Okay, next up for defensive stocks is Casey's General Stores, ticker symbol CASY. So this is a company with about a little less than 3,000 convenience stores. Picture the store where you might have a gas station, a general store, and maybe it sells food, things like that. In fact, from what I was looking at, looks like they make a lot of their revenues generated from selling gas, but margins there are fairly small, where when they sell food inside the store, those margins are significantly larger. Now, they've done a decent job of expanding, and they're mostly in certain parts of the United States, but they have an opportunity to expand a bit more. So I think there could be some long-term upside to a company like this. And we can see on the summary page of the Investors Grow website that the income statement and balance sheet both have 2 stars. So decent. But in this case, the cash flow statement actually has 3 stars because that has trended up fairly good. Then when we jump over and look at the fair value, well, it doesn't look totally undervalued right now. But again, this could be interesting to do a deep dive on. And if nothing else, put it in the bullpen, because when we jump in and look at their dividend, they have been paying somewhat of a dividend. Not a massive dividend yield, but it could be something interesting to consider. Now, this is just a handful of consumer defensive stocks that I have found interesting at first glance. But please let me know in the comments below if there's a company outside of this that we should consider doing a deep dive on, or if one of these companies you think would be worth doing a deeper dive on. Please let me know in the comments below. And if you want to sign up to get access to the Investors Grow website, I'll leave a link right here, a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.